Welcome. I'm so excited to be here today with such an amazing and impressive group of individuals. We're here today to talk about how allocators are optimizing their alternative investment portfolios. But before we get started, I'll just do some quick introductions. Marco Bizzozero is with iCapital. He's head of international. iCapital is a platform that helps RIAs and other high net worth individuals access alternatives. Nuzum is with Mercer, the global chief investment strategist, and has over 30 years covering clients in, I think over 20 different countries. It's really impressive. And then Agus Tandiono is with CPP Investments, head of APAC and Asia Equities, and has really an impressive list of investors that he's managed as he's grown out that global business. And Elizabeth Burton here, Managing Director at Goldman Sachs Asset Management, and also former CIO of Hawaii Employee Retirement System. So we're here today. I think we should start with the obvious question. Assets have grown immensely over the past 15 years in alternatives in an interest rate environment that was very low. Obviously, that's now changed, and fixed income no longer, it's not as challenging to get returns than it was beforehand. Rich, how are allocators thinking about portfolios now for their alternatives?
So bonds are back in terms of investment-grade liquid fixed income, but I don't see anything stopping the rise in alternative asset allocations. In fact, with the good news that we had out overnight from the US in terms of inflation, dropping long-term interest rates, and so on, I think more investors are going to be staying the course going forward. The denominator effect is going to go away for more investors. And so the pressure, the fear of missing out on alternative allocations is back, and we'll see heightened allocations going forward. In response to still relatively higher interest rates than we'd had for the past 10 years or so, investors are responding two ways. If they're concerned about inflation, they're investing in private credit at the short end of the curve to get yield enhancement against short-term marketable interest rates. If they're matching long-term spending requirements, not just defined benefit liabilities, but the desire to have an 8-10% return over long term, they're grabbing the long end of the curve, but with infrastructure and real estate debt as opposed to liquid traded debt to get 2 to 3% yield enhancement against what's now a 4.5% interest rate. And what a difference 3 weeks makes. On October 23rd, we breached 5% on the 10-year Treasury. As we talk here today, we're at 4.4. We've lost 60 basis points of yield on the 10-year that investors could have locked in, which I think is going to bring back that fear of missing out.
Elizabeth, do you, Goldman, share the same view? How are you seeing allocators and how they're rebalancing portfolios, thinking about their portfolios and alternatives?
So specifically for U.S. investors, I was actually quite surprised they didn't change their portfolios. I had thought inflation was not going to be transitory, and when I was an allocator, I did change our portfolio quite substantially, almost 30% of it. And so I was surprised when the asset allocation studies ended in June that I didn't see more movement. What we've seen instead is allocators asking to put hedges on their total portfolio, which is interesting because it's unclear what exactly those hedges are supposed to protect against. Are they worried about geopol? Are they worried about U.S. growth risk? And in a choppy equity market, are those hedges going to pay off for you? So I guess the other thing that I'm seeing is there's been some questions about what to do in public markets on the equity side and investor portfolios. So for those of you who are not U.S. investors in this room, you're used to having standalone allocations to other geographies. U.S. investors sometimes forget that the standalone allocations to U.S. investments are not common everywhere. And they're starting to think about how they can get more juice out of that portfolio since we do expect the equity market to be trending sideways. So looking at 130-30 extension strategies, looking at portable alpha, that's a thing I really haven't heard of in the last 10 years, and that's certainly come back. On the fixed income side, yes, some are looking to shorter duration, but a lot of U.S. Public pensions, for example, cannot allocate to shorter duration in a timely manner or outside of their benchmark. And then across private markets, and I'll wrap this up quickly, I was really surprised that there weren't many changes there. In fact, allocations to private markets have gone up, mostly because they had to as a denominator effect function. And they are allocating less to GPs, but in favor of co-investments. So they're keeping their allocations at the same or higher, but allocating about a quarter of their portfolio to co-investment. And that's happening not just in the US, that's more of like a global phenomenon. And if I recall, when I was the allocator, so I was at Hawaii and at Maryland, and in private markets before that, one of the ways that you can get incremental return, and we talked about at breakfast this morning, is to reduce your fees. So if you do co-investments, you can get a better bang for your buck if they're on a lower or no fee structure.
Great. Lots to dig into there, and we definitely will. Before, Marco, you have the advantage at iCapital of seeing the industry from a much broader lens. Tell us a bit, high net worth individuals typically are investing a smaller percentage of their portfolio in alternatives, but that's growing in terms of interest. What's driving investors to prioritize private markets?
Yeah, indeed. Our mission is really to kind of facilitate access to private markets across private equity, private debt, real estate, infrastructure for individual investors. And differently than the institutional world where, let's say, over the past 20 years, a sizable private market allocation has been built between 10 and even 30% or even more. The wealth management channel, in the wealth management channel, the private market allocation is very low single digit, so on average below 3%. And what we are seeing now, what we are observing now, actually a significant increase across all the wealth managers in making this asset class a strategic priority. And there are actually three main reasons which are all converging why wealth managers are making this asset class a strategic priority. First is really this shift in importance between private market and public market, and I come back to that one. Two is really the recognition that over the past 20 years, this asset class has outperformed, public equity and was really a big contributor in the quality of the portfolio in terms of diversification. And thirdly, there is now technology available who makes those investments much easier for individual investors to do. But let me go back to the first point, which I think is the major driver of why wealth managers are making private market a strategic priority, is this shift in importance between private and public equities. And it's a strategic, structural shift. It's not a cyclical one. But just looking what has happened over the past, not couple of years, but over the past 20 years. Companies are staying private for longer. Most of the value creation is therefore happening when companies are private. And they go public much later, if at all, much later in their life cycle. So if we look 20 years ago, if you were a successful company, on average, after 5-6 years, you needed to go public to raise money. Now you don't need to do that anymore. And if you go public, a much higher valuation. On average now, $3 billion and above. 20 years ago, you went public at average valuation of $700 million. And that's really, let's say, it's an issue for the wealth manager organization that they need to figure out a way to get access to this asset class. If you look at the number of listed companies over the past 20 years, there is today 1/3 less listed company than 20 years ago. And at the same time, the private equity-backed companies increased from around 1,000 companies 20 years ago were private equity-backed to now more than 10,000, which is exactly the same number as listed company. And it goes on and on and on. I think the public market are today not really a real reflection of the real economy. If you look at certain indexes, 40% of the S&P it's kind of between top 5 companies and the technology sector, and 4 of the top 5 companies are tech companies, so 40% of the index is tech. This is not a reflection of the real economy. So there is really this kind of shift between public and private market, which makes wealth managers feel responsible in finding a way to get access to this asset class that in the past was reserved only for institutional investors.
Rich, looks like you want to jump in there. Go right ahead.
Well, I definitely agree with the structural shift. And I think there's a thesis that in the public markets, you can get exposure to emerging and frontier market GDP growth and the positive demographics in emerging and frontier markets through public market companies because they're global multinationals, they have revenue and so on. In the private markets, that's less the case. There are private market companies that are global multinationals, But the private markets, particularly infrastructure and real estate, tend to be more local plays. So the diversification opportunities, I mean, Marco made a good case for the structural shift towards the importance of private markets, but the diversification opportunities are much more real in the private markets than in the public markets, and the ability to get exposure to the small, mid-cap, SME space in emerging frontier markets through private markets is increasing and improving day by day.
Agus,
Yes.
CPP takes a very long-term portfolio approach. How are you viewing private markets and more broadly in the industry as well?
Very good question, Kaitlin. At CPPIB, we have capital for the long term. We're investing for 25, 50 years. So when we look at investments, we look at very, very long term. We invest through generations. We invest through geopolitical risks. We invest through cycles. We invest through elections. And as Rich and Marco mentioned, and Elizabeth mentioned about all the different asset classes, we are very, very diversified. 30% of our portfolio is in private equity, 25% in public markets. We have 25% in both fixed income and credit. We have 9% in real estate and 9% in infrastructure. And when we do investments, when we allocate all this capital, it's for the long term. We invest for the next 5, 10 years. Each time we set an investment department strategy and signals. We are mindful of all these changes, but we tend to ride it through because we have the long-term capital and the patient capital to do that. Yeah, so we do not do so much tactical trading, short-term trading. We do the long-term investments. Yeah, that's the uniqueness about CPPIB.
Makes sense. Why don't we dig a bit deeper into the denominator effect? Long-term portfolio, their composition of portfolios have meaningfully changed because of this growth. There's a lot of different ways that investors are managing that impact. Some are waiting, some are trying different structures. Elizabeth, do you want to comment on what you're seeing in terms of trying to rebalance those portfolios?
Yeah, so I think we might see more rebalancing coming this year, meaning I was surprised the last few years about the number of secondary sales I saw. There were some, but there weren't as many as I thought. You might see more upcoming. I think one of the real losers of all of this has been infrastructure, to be honest, and I can't fault allocators for that. If I was going to make an investment over a 10, 15-year period right now, I'd be wanting to get the biggest bang for my buck. And in some cases, not in all, that looks more like a private equity vehicle than necessarily a strict infrastructure vehicle. But I would also say that if I was still running a portfolio, I'd be looking at deals that were part infrastructure, taking advantage of some of the tailwinds we see in private equity, have some sort of real estate component to them too. Like, not necessarily just those, but I'm saying you should be looking at the assets that span multiple buckets here and may not easily fit into one bucket. And as part of that denominator issue, meaning, I'm sure everyone here in this room knows, but public funds lost a lot of money in the equity and fixed income markets, and so then they were over-allocated to private equity, and those are multi-year pacing plans, as Agus was just saying. And so they had to increase their investment policy statement provisions to allow them to invest more in private markets. And so we haven't seen a lot of culling back on that. What we see as a result is folks thinking about doing their public markets through futures, or utilizing more swaps, or looking at strategies like portable alpha. And I imagine we'll continue to see those sorts of investments going forward, because I don't think that there's an easy way to just sit out a private equity cycle or any other private market cycle. Go right ahead.
Just quickly on infrastructure assets. Some of our assets in the developed markets are performing very, very well because they have inflation hedge.
Sure.
Yeah, so with those inflation hedge in Australia, in Canada, when inflation is high, we can pass it through to higher tolls. So some of those are very, very good assets to us. Yeah.
I think, just to jump in here, I agree with you. And I'm not saying they're not good assets. I agree with you, they are. I think specifically for U.S. investors, and I realize this is a global conference and an Asia-focused conference, U.S. investors were sort of late to get into infrastructure on the public side. And so when they made their first big bites into it, a decade or two ago, and even more recently, for example, Hawaii didn't have, and this is public information, a ton of infrastructure until I got there. So they were going more for U.S.-focused strategies, right? And just like you saw in the direct lending market or private credit markets, mostly when people are just getting into stuff, they tend to go for those bigger trades in direct lending. So yes, there are definitely still opportunities there, But now they're thinking about, well, if I only have X dollars to allocate, where am I going to go?
Rich, we've seen good news overnight related to inflation. How do you see this impacting what Elizabeth said and touching on those points?
I think we might see U.S. allocators coming back into the market more heavily despite the denominator effect. So the good news on inflation caused equities to go up. We're now about 17% up year to date on the S&P 500. We've had a really good 2-week run, and interest rates have dropped. And that directly impacts the denominator effect, but it also takes away a nightmare scenario. As recently as a month ago at the Greenwich Economic Forum, sorry to mention the competitor, Anthony, if that is a competitor, but a number of industry leaders got up and said, we're headed for 7% short-term and long-term yields. The U.S. government budget deficit is out of control. Congress will never get its act together. They painted this nightmare scenario where private equity funds would have to roll over their leverage at very high yields, and we'd have an implosion in private equity and possibly private credit. And so on top of the denominator effect, there was this painting of a nightmare scenario. Now we could still get to that kind of nightmare scenario, but in the rest of the world, in the Middle East, in Canada and Australia, we've seen large sophisticated funds continue to allocate to infrastructure, to real estate, to private equity, to private credit. The U.S. State and municipal pension funds, endowments, foundations, non-for-profit hospitals, those were larger allocators historically. By not re-upping, they've lost some of their relationship equity with the third-party GP community. But I think they'll come back in now, partly because of the market dynamics around the good news overnight, just the change in public market valuations, but partly because that nightmare scenario now looks more remote, the chance of catastrophically high interest rates and what that could do to the global capital markets infrastructure.
Did you want to
So
respond?
I couldn't agree with you more on the difference between U.S. investors and ex-U.S. investors. When we think about the people that are coming into Goldman Sachs or the calls that I'm getting, U.S. investors are not out there hunting as much as ex-U.S. investors for those sorts of deals. And it worries me because sometimes as a former U.S. investor, you get in this bubble and you think your competition is Nebraska. It's not. It's also CPP. It's also like this global world, right? So I totally agree with you that it's different on that basis. On the higher risk for higher rates, I do understand that is still a tail risk that most funds, because they didn't change anything, have to kind of contend with and keep top of mind. So even if it doesn't come to fruition, I still think the right tail risk there remains.
Agus, here we're in Singapore. We're among Temasek, GIC. CPP is another organization that has looked at direct deals for a very long time successfully. They're very complex. Investors are seeming to try new structures like direct deals more and more. Do you have concerns about that becoming more prevalent?
Very good question, Kaitlin. At CPPIB, we have built the capability, one, to invest across all the different asset classes, as I mentioned. We will invest through partners. We will also invest directly. So we do co-underwrite, and through our private equity, through our private credit, and even through our active equities, we do direct pre-IPO investments. As you mentioned, it's very, very complex. We have built the capabilities. We are welcoming more investors to come in so that we can all collaborate and work together. I think that's very, very important because sometimes they can bring different deals, we can bring different deals, and then we can all co-invest together. I think it's very important.
Definitely.
Yeah, and we see a lot of time we partner with GIC or Temasek on a lot of the deals.
Great. Rich, it looks like you wanted to add to the conversation.
Well, there's a very strong trend towards insourcing of direct investment activity for funds with above 50 billion in assets. And some funds are building out great teams. They're compensating those teams at market. But there is a global war for talent, and there's a global arms race around data, digital, and technology to support that talent to be good, active direct investors. And that's true for public markets, but for private markets specifically, if you don't have a competitive edge, if you don't have the right talent, the right technology, the right information, you're in danger of literally providing liquidity to people with inside information. It is private market asset classes, it is buyer beware. So where that trend is driven by cost savings and not kind of keeping an eye on, can we attract the best talent, can we compensate them at market to keep them, our incentives aligned. So we're actually seeing a big uptick in explicit benchmarking activity where investment committees, boards of directors, CIOs are asking, hey, we think we're good at this. Can you benchmark us to other in-house teams, but also to the commercial general partner community, and tell us are we competitive at this, or are we at risk? We're doing this conference near a casino. Are we at risk of being the dumb money at the poker table and inadvertently giving liquidity to people with better information? So I think that's something to be conscious of as you navigate through the world. Where do you have competitive edge and where not? And Agus talked also about the ability to stay the course, long-term time horizon, cash flow positive. Funds that have those characteristics are very attractive investment partners. Funds that are more subject to the buffeting of geopolitics are not. I'll just tell one anecdote. I spent a week in Dubai and Abu Dhabi a couple weeks ago, and I carry an American passport, even though I've worked half my career outside the U.S. I got teased about, hey, when we go to China now, we don't see any of your countrymen. There's no Americans in the Chinese hotels looking for local deals. I think there's truth in that statement, and that kind of demonstrates the opposite of stay the course, long-term perspective, ignore the geopolitics, and continue to partner for the long term.
May I add something?
Of course, go ahead.
Rich has highlighted very, very important points, which is local partnership and local edge. Because we as foreign investors, when we go to a new country, people will think, here comes the new capital, and they do not know the local markets. So at CPPIB, we have 327 partners globally. Whether it's global private equity funds, whether it's local private equity funds, we partner them so that they can tell us, do not step on this landmines and that landmines. Because stepping on landmines and preventing fraud, that's half the battle of investments, right? And so I totally agree. We do have a lot of partners that we work with globally and that will help us invest. And then along the way, we have the active teams to co-invest with them. Yeah.
Great. Marco, from your role, you're building out iCapital's business here in outside of all of the U.S. What trends are you seeing in terms of technology, talent, and also just educating this, a different investor space on alternatives?
Hey, our mission, as I said before, really to make it easy for advisors and their client to get access to everything that we have been talking here about. And if we reflect a little bit about, over the past, let's say 10 years, how difficult it was to invest in those strategies, whether it's private equity, whether it's private debt, whether it's real estate, whether it's infrastructure. And there are many reasons why the allocation of wealth manager now, as I said, is single digit and not, I was making the math when you were talking about it, you have more than 50% in private market. And why individual investor didn't manage to get to that. And it's a list of barriers that existed. And the barriers were, first of all, figuring out with who to invest. Who are the asset manager where I can put my money with? A lot of intransparency there. Two, even if you figure out who the managers are, then the minimum were very high. Needed to invest 5 million, 10 million in a single ticket. So very difficult for a private investor, obviously, to do that. And then think about the process, and this is very important. Think about the process. Those are not mutual funds. This is not single stock. The difficulty in investing, to filling up subscription documents, and then investing into something that reports only every quarter. And everybody's reporting in a different way because the stuff is not listed, it's public. Think about the structure of the fund. Usually they work with capital code, with distributions, and they are long-term. So a lot of barriers. And this really prevented advisors, first of all. And the advisors are the gatekeeper to the wealth. The advisor come before the clients can look at it. And now all those barriers, are actually eliminated with the support of technology. Technology and education, those two things, is something that actually is part of our value proposition, are really there to eliminate all those barriers and really facilitate the work of an advisor and try and figure out a way to build a long-term portfolio over time, diversifying across manager, across strategies, across vintage years. And that's actually what we are seeing that is happening, really across all the regions and especially here in Asia as well.
Got it. Go ahead, Rich.
I think the access for individuals of whatever wealth and income level to alternatives across nation states is a really important issue, and love to see iCapital driving innovation in that space. We did some work with the World Economic Forum a few years ago looking at the default defined contribution investment option across 12 countries, and we modeled out that Australia had the best defined contribution investment system. An individual Australian, I think there's some Australians in the audience, can walk in off the street and get exposure to a diversified portfolio that has more than 35% in liquid alternatives, which is managed by an in-house team, partly in-house, partly using third-party general partners. But as an individual in Australia, you can get that. Unless you work for a handful of U.S. public funds that, or public entities that are invested by a public fund that has put alternatives in their DC investment option, in the United States, you can't get that. In most countries around the world, unless you're a family office and very large and effectively institutional, you can't get that type of alternatives exposure. So given the structural shift that Marco described earlier, in most countries around the world, we're leaving our citizenry out of the diversification opportunities, the return opportunities that institutional investors have access to. You know, CPPIB provides that indirectly to Canadians. So there are countries where you know, you get that exposure indirectly through your sovereign wealth fund, your national social security fund, other fund. But those are the exceptions, not the rule. And I think that will change over time because individual voters will push their regulators to allow that option.
Elizabeth, Goldman obviously has a very big client advisory business as well. Do you have any comments along the lines of this trend?
Unfortunately, I couldn't hear at the very end. But you know, I think it is obviously a really fast-growing part of the business. My husband works in that space, actually, full disclosure. The one thing that makes me a little bit nervous is that it's not always exactly democratized, right? So if it's a more liquid product, you're not getting the exact same expected return as you are in an illiquid product by definition. So it's not entirely clear to me that has been like thoroughly communicated in the marketplace, that individual investors are still kind of getting, you know, a slightly worse deal, let's say, in some cases, because you're giving up, unless you want more liquid for less return, and in some cases you do. Like as a former allocator, sometimes we gave up more to get a managed account with better fees there. But one anecdote from a conference provider, it wasn't this one, I'll say, is actually turning its back on institutional investors and going purely for the retail investor now because it's such a hot market. And I thought that was really interesting because it's a conference provider that everyone in this room would know and has probably been to as well. So definitely room to grow there.
Great. Let's shift gears slightly and talk about real estate. It seems like we're either already seeing the implosion, we're at the implosion, WeWork filed for bankruptcy. Anyone can take this question, but curious to see how how should allocators be thinking about real estate within their portfolio, real assets more broadly, and then also we can dive a bit into the local trends as well.
Maybe I can start. Real estate has not been a very good word, especially real estate in China. And real estate is very general. A lot of people, to have exposure to real estate, you just invest in REITs for the public markets. At CPPIB, we are very, very active in real estate, and we do it with partners. For example, we were worked with Goldman in China to turn a raw piece of land into a warehouse, modern warehouse. We will work with Japanese partners in Japan to turn a raw piece of land to build data centers. And when we do all these developments, we take development risks, but the development margin is 60%. Some of it is 50, 60%. And then when you look at the IRR, actually it's very, very high. We were in China building warehouses with GLP as well and Goldman. And you know, this is even before the e-commerce took off. And when e-commerce took off, we have all the modern logistics throughout China. Yeah, so that's how we look at real estate. And when the assets is mature, Kaitlin, then we will dispose them, either through REITs or through selling it to the insurance company. So that is our real estate. It's not buying REITs and capturing dividends.
Right. Rich, do you want to share your views?
I think the challenge and opportunity for all of us as long-term investors is we have to buy the future. We have to kind of predict the future and diversify across different states of the world and navigate that. We can't buy the past. And if you have a portfolio where everything you've done has outperformed for the last 10 years, First, I want to go to the casino with you and back you. But secondly, I mean, that's great, but that probably means you didn't have a very well diversified portfolio. So we've had, with a tailwind from COVID, we've had this massive wave of digital disruption. Work from home is now legitimate. It helps with globalization. There's untapped parts of the workforce globally that are now doing work assisted by AI. I mean, just on, good news economically and in terms of employment and labor force participation and so on. But with that has come a disruption to traditional patterns of usage of real estate, especially commercial real estate. Another piece of good news, 3 years ago, working on transformational investment with the World Economic Forum and some of the Singaporean funds were leading in that work. One of the biggest risks they identified was low and negative long-term real interest rates. It was only 3 years ago that half of the investment-grade debt on the planet was trading at negative real yields. And for any long-term investor, that was a horrible situation. And now we sit here today and real yields are at 2.5% and 3%. That's really good news. We can get part of our expected return risk-free over 10 or 20 years. It's really good news. But with that increase in cost of debt, real estate's taken a hit. Well, okay, it's in a diversified portfolio. It's not standalone. So the question isn't, are you happy with the returns on the real estate investments you made 10 years ago? Maybe not, but the rest of your portfolio has done really well. The question is, what are you going to do for the next 10 years? And we think, committing to real estate, helping repurpose properties, commercial to residential, whatever it is, that makes sense as we navigate this world going forward. But let's sit back and think about all the good news in digital disruption and higher real yields that offsets whatever bad news we've had from the holding period returns of our 10 years ago real estate investments.
Totally agree. We have to look forward. What's the next investment theme in real estate, like data centers, warehouses? So that's where the direction is.
Definitely. Elizabeth, did
The
you
only
want to
thing
share?
I'd add to that, and I agree with you on data centers, warehouses, we hear about storage, all that kind of stuff. But to Rich's point too, like everybody is saying to invest in that, right? So like in some point in the future, we're going to get some issue in that market, and there's going to be concentration in portfolios and those sorts of investments too. And I actually think when everybody hates a market is when you should be looking at. I remember like in 2018 when the 𝐻𝐢𝐬𝐫 kind of blew up, someone said like, oh, no one's going to trade vol anymore, which is absolutely the most ridiculous comment I've ever heard in my life. Like vol is just going to go away. But also, I think we need to keep this in perspective. Yes, interest rates seem high now, but you need to look at like the entire history of the world, and they're not even like close to the average. So I think we need to keep that in mind. I mean, my house growing up had a 17% interest rate on it. We weren't on Park Avenue. I grew up on a cattle ranch. So if a cattle farmer agreed to pay a 17% interest rate, like it can be done. And also there's other parts of real estate, kind of to your point, that also looks interesting, and maybe it's not on the equity side. Like I actually think real estate credit might be an interesting place to look. And in private credit portfolios, if investors don't think that real estate credit's going to end up in your private credit portfolio, I think you're wrong. I think you need to look at those documents and make sure that that's not going to be in there. But like I think I can't remember if I said it here or I said it at breakfast. I just think like the way capital is used is going to be changed. Like these things just aren't going to be dead. They're going to have to be revitalized and changed and used. So to say I'm never investing in this, which I hear a lot, I'm never buying this sort of office space again or something like that. Like anytime you put a rule in place, it usually has adverse consequences.
Rich, do you agree?
Well, I agree, and I think some institutional investors have governance bodies that are backward-looking and governance bodies that are focused on first-order issues. And what I mean by first-order issues is what's the story in the real economy, not what's the valuation and what's the forward-looking story. So as a non-real estate example, there's been lots of bad economic and policy news out of China in the last 18 months, some disappointments, lots of good news about India. So on a first-order look, you'd say, well, invest more in India, less in China. But then if you look at public market equities, India's trading at a PE of 20 times forward earnings, China's trading at 9 times forward earnings. So if you've got a 10% absolute return objective, you can lock that in by investing in China onshore equities. You can only get half of that by investing in India. Another way to put it, Indian stocks have to grow their earnings twice as fast as Chinese stocks forever to justify that valuation differential. So as investors, we have to look at the second order effect, and if other investors are going to be backward looking and look at first order effects, that's going to create opportunities for us to put money in places that they're neglecting, which right now would include real estate.
Marco, what are you seeing as we think about fundraising and GPs more broadly? Rich was talking earlier too in our prep call. He said, hedge funds are back. What other strategies are investors looking to right now?
I think, if I look at the interest from, let's say, from the wealth management channel, looking at all those strategy, I think the starting point is completely different than on the institutional side. So the starting point of a normal private client portfolio is 60-40, with zero, let's say, allocation to alternative. And for the reason that we talked before, now is the time to really strategically think it through and make a choice. Do I want to move away from this 60-40 and create a significant, allocation? It doesn't matter if you just do 1, 2, 3%. It's not going to move the needle, neither in terms of returns nor in terms of diversification. So you need to go and move towards, the allocation that we were talking about, 10%, 20%, 30%. And that's the first decision. And the second one is doing over time. It takes time. It's a long-term investment. It takes 5 years, let's say, to build it. And then you need to build it in a diversified way, across all the sub-asset classes of private market, private equity, and you look at buyout and mid-market, distress, venture, private debt, very interesting, actually, currently. Real estate, individual clients, they always know everything about real estate. That's a little bit different. But infrastructure, very interesting also in current market environment because it's a natural edge against inflation. And on private equity, also, I think it's important to remember, notwithstanding obviously the negative impact of higher interest rate and let's say less availability of financing. But the advantage of capitalizing on the entry multiple, which are much lower, this makes a huge difference and can really overcompensate the negative impact on higher interest rate and lower availability of debt. And history tells us that the best returns in this asset class are generated when investing 1 year, 2 years after the peak. And that's where we are right now, and that's where people are looking at it.
Right. Liz, I think you had said, go ahead. It looks like you were going to jump in.
Go ahead.
I'll spare my question. I say, you had said in our call, is there too much money raised as part of fundraising in private credit? No. Curious if you wanted to speak to that as part of Marco's narrative.
No, and then I actually will jump on the earlier comment too. No, I don't think so. I started out as a bond trader. I traded mortgages right before the global financial crisis, which was a super fun time to be trading fixed income. But in terms of just to take one step back, it takes a time to build a resilient portfolio. So I agree with you. But I would say one thing. If you assume that we're investing for 900 years, to never change your portfolio and say we're just long-term investors, I think everyone, I hope, in this room would agree your portfolio should not look the same 300 years ago as it looks today, right? So there are some inflection points in history. And yes, it might take time to build a resilient portfolio. But if you really like private equity, why wouldn't you do levered small caps or something in the short term? So I've been a long-term investor, but I think that there are things. So if you think interest rates are going to be high and you want to stand up real estate and infrastructure overnight, then do a PME or do a swap or do something that can hold you over in the meantime. So at some point, I think investors need to think, we are not going back to 2019. This is different. You cannot expect 2018, 2019 is done. This is a regime shift. Something is going to be different. So you are a long-term investor and you want to be stable and not invest in fads. At the same time, I think you need to think about the 300-year phenomenon, not the 10-year phenomenon. So I'll get off my soapbox now.
Rich, did you want to chime in there?
Well, I think one way that capital markets are changing that investors can try to get ahead of is the importance of infrastructure as an asset class and early stage private equity, including venture capital as an asset class in the emerging and frontier markets. We still use that label of emerging and frontier markets. Most of those markets have emerged, improving rule of law. There are local investment communities investing in those asset classes that are local native. Agus talked about the partnerships they have with those types of investors. But there's parts of the global economy that are growing fast that you can't really get exposure to other than going into local private market asset classes. So I think that's a massive area of growth. I'm trying to get a paper out on that. I committed to get it out before COP28. We'll see if I hit that deadline. but I think that's a huge investment opportunity. And those asset classes produce positive externalities. When you fund local infrastructure someplace like South Africa, you're creating local GDP growth that your public markets portfolio, those global multinationals, are going to capture part of for you. But there's part of that you can only get at by being local. So I think that's where we'll see an explosion in underlying market cap over the next 10 years as we continue to try to find, we're in an overemployment economy in the developed markets, and we've got the technology to make use of labor with AI assistance that we haven't made use of historically. We're going to find that labor in the emerging frontier markets and put that to work in the global economy.
Great. Well, you've all had incredibly accomplished and interesting dynamic careers. We'll go into a few rapid fire questions for the last few minutes that we have on stage. What are you personally most excited about looking ahead for the markets and for your role at your organizations? We can go left to right, Liz, if you want to start.
Oh,
or we
God.
can go the other direction.
Let's do the other. Most excited about. Most excited about. I'm hoping that when I look at portfolios of U.S. investors specifically over the next 10 years, they look more geographically diverse. I think if we have higher sustained interest rates, whether or not you think that's going to happen, the equity bond correlation stays sticky. And so people need to start thinking, to your comments about 60-40, about how much geographic diversification they have in their portfolios. And especially with diverging interest rates, now is the time more than ever in my career that you should be thinking about that.
That's great.
I agree. I believe diversification is key with the different asset classes and also geographic. The high interest rate that you mentioned, Kaitlin, is in US.
Right.
Is in certain economies connected to the US. But when you look at APAC, China has a different interest rate cycles. Japan, although it's increasing, but it's still very, very low.
Right.
Right? So when we invest, we look at diversification, uncorrelated returns over the long time. Yeah, so back to your questions, we are looking actively in equities in Asia as well, right? Given the uncorrelated cycles. Yeah, so we are actively looking in those markets.
That's great. Rich?
I've already given the headline on emerging frontier market infrastructure and early stage private equity, but I'll add to the why. So building on Elizabeth's comment, when you look at countries where the average institutional investor has huge home country bias, it tends to be countries that have done really well in their public equity market. And the US is the main culprit. And there's a lot of funds that are implicitly or explicitly peer group median benchmarked in the US. And so huge home country bias towards US stocks, huge home country bias towards other US asset classes. If parts of the other rest of the world start to outperform, whether it's China, Japan, India, emerging frontier in general, you'll see a wave of money coming from the US because backward-looking governance bodies will look at the recent returns and say, okay, our consultants have been telling us for 20 years to diversify. I guess they're right, because in the past 3 years, they've finally been right. We as a community haven't been right for 20 years. The US has continued to outperform. Just one story, I was with the treasurer of a global multinational, and his committee was pushing back against global diversification because the US stock markets have done so well. And I said, John, could you talk about the other 17 countries we work with you in and how much being global diversified has paid off? And he laughed and he said, that's right. In the other 17 countries has paid off. The US is the one country where diversification hasn't paid off. But if and when that changes, you'll see a wave of money coming from the US into emerging and frontier market asset classes. And if you want to outperform in investments, you need to be early and you need to be right. And so getting in early ahead of that, I think, would be a good thing for all of us.
Marco, what are you most excited about?
What I would say is, and as you mentioned at the beginning, we're kind of a great observatory point, to see what wealth managers are doing, are deciding in terms of, including this asset class as part of a core portfolio. And what's rewarding to hear is that, yes, everybody now talks about this great business opportunity of including, this asset class in the portfolio because of returns and because of diversification benefit. But many talk goes beyond about a business opportunity, and many use the word, it's a responsibility. It's now becoming a responsibility to facilitate access to this asset class, which in the past, many years has been reserved only for institutional investors. And that's moving from business opportunity to responsibility. I think it's something which is quite rewarding to hear.
I feel that responsibility. I also think we've talked a lot about institutional investors, which we tend to do these conferences, but the family office and the ultra high net worth retail segments globally, those are actually bigger savings pools now than the sovereign wealth community in aggregate, and they're growing faster. So the work that iCapital is doing, access that governments are doing to try to change regs to give individuals access, that's actually really important as a tailwind for alternative asset classes, and we haven't seen that kick in yet.
Great. Well, final question, very rapid fire. We just saw a headline from UBS saying that they expected the Fed to cut rates by 275 basis points, more than 4x what the market is predicting. Do you agree, disagree? And if you disagree, how much will they cut by?
Disagree. Maybe another cut end of next year.
Disagree. Cut 50 to 75 basis points.
Got it.
Disagree because the magnitude's big, but directionally I'm aligned with that. Kathy Wood commented yesterday that deflation is going to come roaring back. We see deflationary pressures globally in AI and digitalization and globalization, and I think we'll be back to lower nominal interest rates quickly, but not 3.25 by the end of next year. I just don't think monetary authorities will act that quickly. I think they will follow market consensus as opposed to leading market consensus, and they'll be data-driven, which means backward-looking. But you look out 3 years, I think we'll be back down to 2% on the 10-year Treasury, nominal.
Marco, final
If
closing
everybody disagrees, then I need to agree, but I think the order of magnitude is probably a little bit too much.
Yeah. Great. Well, thank you all for being here. Great conversation, and everyone enjoy the rest of the conference.